Inflation eased a bit more than expected last month, providing some welcome news for consumers. But Federal Reserve officials say they want more progress and don't expect to cut interest rates much this year. Last month saw the mildest inflation increase since 2021. The Consumer Price Index rose 0.2% in May and was up 3.4% compared to a year ago. That is excluding the more volatile costs of energy and food. Hospital services, rents, and restaurant prices all climbed higher, but there was a broader slowdown for other goods, including gasoline, dairy products, and airfare.
That inflation news provided some relief compared to recent reports. Polls show that inflation has consistently remained among Americans' top economic concerns. Today, Federal Reserve Chair Jerome Powell said he wanted to see more progress in the battle against inflation, too. In fact, after projecting as many as 3 rate cuts for 2024, Powell said today the Fed may only cut interest rates once later this year.
We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Economist Diane Swank of KPMG said keeping interest rates at a higher level could mean more pain for millions.
Those who get hurt from higher for longer interest rates are everything from small and mid-sized businesses that are set to reprice their loans this year. They're not in fixed price loans. And also consumers, particularly low-income consumers and younger borrowers who are seeing the rates compound on their credit cards. They've already tapped out their credit cards to make ends meet and are now having that compounding rate at a very high rate, which means you're seeing delinquencies rise as well.
The inflation news also finally contained a bit of good news about your auto insurance premiums. They've been rising for months and are one part of why inflation has had such a bite. While they finally dipped just a bit today, they remain much higher than a few years ago. Economics correspondent Paul Solman takes a closer look at why that is.
Car batteries have skyrocketed. They've probably gone up 15-20% for a car battery.
In the last year?
In the last year.
Steve Regan and brother Pat run my neighborhood auto shop.
This tire here was $20 or $30 less for this tire even a year ago.
But the big new cost for auto repairs, higher tech parts.
There's a lot more electronics than there ever were. Your car, for example, probably has 15 different computers in it, maybe more.
And this stuff is expensive to replace, more so with every added computer chip.
A little lens like this, just the part,
can
cost $125, $150.
Cameras, parking sensors, self-parking capability. This stuff can all be damaged in a front-end collision.
Like a busted rear view mirror and a parking sensor knocked loose before I bought the car.
See, you can see where the crack was, look.
Body shop quote, $3,000. But my wife glued the mirror housing, impressing Steve.
She did a good job.
Who advised reattaching the dangling, forever beeping sensor.
I see your tape job.
Yeah,
and I wouldn't give up your day job.
I don't intend to. Meanwhile, no surprise that what's true in suburban Boston is true elsewhere.
The cost of labor surrounding vehicle repairs is increasing. It's still about 20% higher now than it was before the pandemic.
Which also, crucially, means insurance rate hikes, says Bankrate columnist Shannon Martin, up 26% nationwide this year, 40% higher than pre-pandemic.
So all the technology that helps keep us safer on the road also means it costs more to have your vehicle repaired. And then in terms of labor costs, and America's been experiencing a labor shortage in the world of auto technicians for some time now. And there isn't the same pool to pull from, and this is driving up the cost of your car insurance and delaying the time it takes to get your vehicle repaired.
Insurance prices have just increased dramatically.
Al Calderoni is a Regan's regular.
Those companies are really taking advantage of the consumer in a variety of different ways. In general, there's a lot of industries that are gouging.
Insurance companies among them, he thinks. But what choice do they have, given the lofty parts prices car manufacturers have been able to impose, says Adam Siegel, a third-generation principal at family-owned Webster Auto in Somerville, Massachusetts.
They're adding either technology, trademark logos.
But why do I need to put a logo on there?
I guess for continuity, for if someone comes in here and Our obligation is to get that car back to the previous condition or other methods of eliminating the opportunity for aftermarket parts creators.
You mean eliminate the opportunity for competition?
Exactly.
That condition included branded parts instead of any made by third parties in the aftermarket.
CMC, Sierra.
So the manufacturers have a de facto patent. Siegel challenged me to estimate the repair of this collision-bruised behemoth. A few scratches, a dent I couldn't even see.
Give it a ballpark.
First place, I have to tell you, I would get the paint and I would try to do that myself.
Absolutely.
This I wouldn't care about at all. So I would say the cost would be zero.
Yeah.
How much is it?
I'd say $5,500.
$5,500 for this scuffing and that dent?
Yes, yeah, there's a lot to this that the naked eye will never see, and we have parking sensors.
Yeah, I see the sensors, but
we have a front-facing camera. We have
Yeah.
cruise control radar.
Yeah.
There's a lot of tech in this car.
But the 5500 wouldn't even include replacing any damaged sensors. Meanwhile, back at the Regans,
Had that one headlight cracked in that accident. That headlight is a $10,000 headlight. And
What are you talking about?
the headlight that's how much that headlight would cost.
$10,000?
$10,000.
So insurance companies pay for pricey parts
Tires are very volatile.
whose prices manufacturers control.
Let's say we order a bumper from Mercedes. They'll charge us a $150 to $300 core deposit, and in order for us to get that money back, we have to give them the old bumper. The reason they do that is to eliminate these bumpers from the market in general.
And get this, because repairing a modern car costs so much, damaged vehicles, especially high-end ones, are often considered totaled. So cars that could last 15 to 20 years or more are regularly soon scrapped.
A lot of these luxury cars, the parts prices are so high that it is difficult to get into a repair of a car that's 7 to 10 years old without totaling it out, because there's just not that many aftermarket options for these vehicles.
Hey, even high water could short out the electronics and render a car not worth fixing.
You could make the case that a car is now, mostly a computer.
Insurance expert Maria O'Brien echoes the mechanics.
When the car is involved, even in a relatively minor accident, if it turns out that a sensor is damaged or something else related to the computer system is damaged, what might have been a new plastic bumper is now considerably more.
And of course, says O'Brien, a law professor, manufacturers will do whatever they can to make sure the replacement parts are theirs.
Which doesn't mean that they are necessarily breaking the law, but they are absolutely going to try to manage the availability of their product in a way that results in the biggest profit possible for them.
And as our cars and trucks become more computerized every year, the more potential for profit, because the pricier the irreplaceable parts, which helps explain skyway high auto repair inflation. For the PBS NewsHour, Paul Solman.